What for you are the highlights of these results?
Well, first thing I would say is that exactly a year ago today, we were a cash shell with no revenue, no businesses. And today we have 140,000 customers, we have 80 offices, we have 1,350 employees and agents. We have a loan book which is approaching 150 million, and we have 3 credible businesses. So it has been a year of real achievement and a very busy 12 months. The second point is that all 3 businesses are growing according to our plans, and that is extremely encouraging in today's economic environment. And the third point I would make is that we're paying a dividend. This is our first dividend, and after such a short period of trading, I think this will be well received.
Have you got all the new management and operational structures in place in the operating and PLC businesses now?
Yes, we do. We have changed management in certain parts of the business, and others had already existing extremely good management. All of those are in place. We have all the necessary structures in place.
Your strategy to increase the branch numbers for everyday loans flies in the face of the high street banks and must be expensive. Can you explain?
Yeah, we are very different from the high street banks. The high street banks lend generally to customers with prime credit ratings. We are aimed at the 12 million UK adults who the main high street banks will not lend to. So we're very different, and in order to lend sensibly and understand the needs of these customers with credit ratings which are either impaired or thin, we feel it's vital to meet them face to face, and in that face to face interview, either in their home or indeed in the branch, we establish what their real needs are. That's very different from the high street banks, and that's why we will be expanding our branch network as opposed to the high street banks who are shrinking them at the moment. As regards the additional expense of the branches that we're opening, that's actually relatively modest, and the payback is quite quick, about 19 months.
You say the growth at Loans at Home has been greater than originally expected, and costs have also gone up. What's happened?
Well, what's happened is we've seen an exceptional market opportunity. The largest company in the market has actually shrunk its size in the market, which has given us an opportunity to grow. And hence we have seen credit issued growing by 27% in the first half of the year. In order to support this growth, we have appointed quite a lot of new agents, indeed 50% higher than a year ago. In order to provide support to these agents, we provide supporting commissions over a short period of time while they build up their customer base. The second thing that's really important is that we have a much more conservative accounting policy than under the previous ownership, and we start to impair loans after just 2 weeks of non-payment as opposed to 10 weeks of non-payment. This means that impairment has gone up, but it is all as a result of the growth and will feed through to positive results in the second half.
You're testing and rolling out a couple of handheld apps for collections and the loan application process in Loans at Home. How will these help, and do all the agents have suitable handheld devices?
Yes, all agents have mobile phones, and secondly, the app can be fitted to all types of mobile phone. So that is working fine. What it does is to provide a really good audit trail for compliance, and from that point of view, it is a very important step for the future of the business. Compliance is absolutely at the heart of our culture throughout all of our businesses, and we see that throughout, really from top to bottom throughout the organisation, and we ensure that as far as is humanly possible that we always get a good customer outcome. In terms of efficiency, yes, it helps a bit, but to be honest, the efficiencies will be reinvested back in the business.
What's the opportunity for Trust 2, and what's your strategy for its expansion?
Well, Trust 2, being a guaranteed loan business, is in a very interesting market. It is a market that's growing fast. It has an exceptionally successful market leader with a market share of around 75%. We see this as a major opportunity. We have an extremely credible platform in Trust 2. We have first-class management there, and there are two particular opportunities. The first one is that through our branch network, we have a unique source of leads which will help us grow. The second one is that the broker community, who are an important source of leads, find being dependent on one large market leader just a little bit difficult, and so they are welcoming us into the market and providing us with a lot of support.
What would happen if Loans at Home doesn't get FCA approval?
Well, to be honest, I don't think that's going to happen. When you look at it, first of all, under our ownership, Everyday Loans and Trust 2 has received a full FCA licence. Secondly, the FCA has granted licences to well over 100 home credit companies. What they are doing is looking at the three largest, of which we are one, and they are indicating that they will give licences on the same day to each of the three largest players, which includes us.
Do you view peer-to-peer lending and payday loans businesses as competition?
No, they really are very different indeed. Payday is extremely short term, within the month, and peer-to-peer is mainly aimed at prime credits as opposed to impaired credit. So possibly at the margin, absolutely tiny bit of competition, but really not anything that's strategically worth considering.
You say Brexit may offer you opportunities. Can you elaborate?
Yes. Brexit, or what was happening in the economy anyway, has caused a bit of a slowdown in certain sectors. The banks appear to be tightening their credit criteria, and this means that some customers who otherwise would have got credit from the banks are now finding that they're not and come down into our sector. And secondly, the banks also appear to be constraining credit to some of our smaller competitors, which means that they are constrained as far as further growth is concerned, and this means more customers coming to us as well.
Your maiden dividend of 0.3 pence per share is a little less than some people were expecting. What's your view?
Well, my view is that we acquired 2 out of the 3 businesses on the 13th of April, which is only 2.5 months before our half-year figures. And so to be paying a dividend after such a short period of time is something that will be hugely welcomed by shareholders.
There are normalised and reported results in this announcement. What should we focus on, and which for you are the key numbers?
The reported numbers include a number of accounting adjustments reflecting the acquisitions we've made. So I look at the normalised numbers. Those numbers exclude those acquisition adjustments and enable me to see the business in a clearer light. We've also included pro forma numbers, which show the impact of the business had we owned Everyday Loans from the 1st of January. So that shows the scale of the business in the first half. Finally, we've excluded the additional commission payments we've made to new agents because they're one-offs, and we expect them to decline in the second half and into 2017.
Admin costs, especially in branches and agents, might seem high to those new to the company. Aren't customers wanting to transact remotely rather than face-to-face, which should bring costs down?
We believe that for the customers that we seek to serve, who are credit impaired or have thin credit histories, face-to-face meetings are critical. So both in a branch or with an agent network, it's a critical part of our business. That does add costs, but we think that it's the way to best look after our customers. Customers do come to us through the web, so the web is an important source of leads, but it's not a way that we seek to serve customers.
Impairments are also a major cost, particularly at Loans at Home, where they represented around 38% of revenue in the first half. Once impaired, are they impaired forever? And what's your strategy and policy re payment defaults and impairments within the 3 businesses?
So we have a slightly different approach for the 2 businesses, the 2 big businesses, Everyday and Loans at Home. But in both cases, once we have evidence of impairment, we start to provide. In Loans at Home, we're very conservative in our approach, and if a new customer misses 2 payments, we start to provide, and if an existing customer misses 4 payments, we start to provide. And once they've missed 13 payments out of 13, they're pretty much fully provided. That's a much more conservative approach to provision than the previous owners who didn't provide until 10 payments had been missed. Every day is a little different, so we provide a very small amount on every new loan because we know that some loans will go bad, and then as loans move through the default process, we provide a further amount. And if a customer misses 6 monthly payments out of 6, we then fully write off the loan. We anticipate that at Loans at Home, the impairment will come down in the second half. We're currently writing a lot of new loans to new customers, and with our conservative policy picking up impairment early, we see quite a big impact in the first half.
Your loan loss provision is higher than the total impairments charge. Why is that?
You always have a provision at the beginning of the period, you top that up, and then you write off an element as loans finally default, and then you carry forward a balance to the next period.
Given the nature of the market you're in, there are bound to be some impairments. Do you have a target acceptable impairment percentage KPI for each of the businesses?
We haven't set a target for the businesses, and particularly not for Loans at Home. The scale of growth that we're seeing at Loans at Home is unprecedented in the home credit industry, so to set a target might well limit our growth opportunity. As I've said though, we do expect the number to come down in the second half as we move through the year.
How much do you expect to invest in expanding the branch network of Everyday Loans, and over what period? Do you plan high street visibility or not?
The investment is fairly modest for each new branch. It's a couple of £100,000 to put into the staff cost and the premises. We get to break even in about 11 months, and we're planning to open 5 this year. So that gives you a sense of the scale of investment. We then see scope for up to a further 15 branches, so that's 20 in total new branches. But we don't see us going for high street glass-fronted branches. It's very much a business where customers are invited into branches, so actually off high street with parking is the ideal premises.
You say allowing an extended customer base and expanded product range at Everyday Loans has increased yield. Can you be more explicit about what you've done?
Secure Trust Bank had imposed a hard cap in terms of the APR that they would deliver, so the maximum APR, and that meant a number of customers that had previously been served by the business were no longer economically viable, so the business had to restrict the customer base it served. We've removed that cap, we're happier with the higher APRs, and therefore we've expanded the customer range, and that has had the impact of improving the yield.
Is there a time or quantum limit for the additional commissions you've put in place for new agents for Loans at Home? And is it the same for those who've recently come from competitors and already have contacts?
The focus of the additional commission payment programme is on experienced agents coming across from the competition. When they arrive, they don't bring their customers with them, so they have no income. So we provide additional commission for up to 6 months. And then as they build up their customer base, bringing across customers, adding new customers that they find, we reduce those so that at the end of the 6-month programme, they're funding themselves through commission.
You have plans to grow Trust 2. How much are you planning to invest in what? And what sort of ROI are you looking at over what period?
The investment is fairly modest. So we've already announced that we've hired a Managing Director, Richard Chart from Dollar Financial. We need to add a few additional staff, and then it's really letting them grow the business, particularly using a branch network to refer loans across to Trust 2. That's the kind of key focus. We're looking for a return on asset of 20% as with our other businesses, and we're targeting a 20% annual growth in loan book.
You've recently increased your corporate borrowing facilities by £10 million. Are you confident that this gives you enough scope to deliver your 20% annual loan book growth and ROA targets over the medium term?
Our facilities are in place until December 2018 for Everyday Loans and to June 2019 for Loans at Home, and they provide enough capacity for our current plans to grow our loan books at 20% per annum. We will explore additional funding options so that we can support faster growth, and that could include mezzanine debt, retail bonds or securitisation.
How has the second half started, and what should we expect given that the second half is traditionally stronger in the run-up to Christmas?
The second half has started in line with the first half, so we're seeing strong loan book growth in all 3 businesses, and we think we're well placed to deliver our 20% growth in loan book across the year.